So why is the income you get from rental homes so much better than the income you get from bonds and fixed income? Well, this is Michael DeVille in beautiful Phoenix, Arizona. We're going to talk about that today. You know, most of my clients are baby boomers, and income is incredibly important to us because once you retire, we've been living on this income stream called a job for 30, 40, or 50 years. And when that job goes away, we have to live on our investments. And those investments, either we're selling our investments each and every month, depleting our nest egg, or we're living off the income. And it's a long time that we're going to be retired. You know, we forget we're going to be retired for 10 years, 20 years, 30, you know, and my wife comes from a long-lived family. She could be easily retired into her early 100s, so that would make it 40 years of retirement. That is a really long time for a nest egg to last. So we really need to have some kind of an investment for ourselves that's throwing off income. And most of the people who are well-to-do have income streams. And we want to talk about that. We want to talk about what makes that difference between a fixed income and rental properties, which are a variable income. So let's just talk about inflation first off, because I did a video this week. People are really concerned about inflation. It's been into buzzwords. So let's go right to my slide if I can. See if I can share the screen and we can take a look at it and we can talk about what we're looking at right here. So inflation, what exactly is inflation? Well, inflation for most of us is going to mean rising prices. I mean, there's just no ifs, ands, or buts about it. We've been in a very, very benign inflationary period really since the turn of the century. Since 2000, inflation has been less than 2%. But here is the startling fact that if you retired in 2000 with benign inflation for 20 years, less than 2%, your purchasing power is down to 51.5% of what it was in 2000. With benign inflation under 2%, you've lost almost half of your purchasing power in 20 years. And we're going to be retired for at least 20 years. That means if you retired with $100 grand, man, you were just living well at $100,000. Well, that purchasing power is down to 50, and you're not 65 anymore, you're 85, and you have the same kind of costs. So here's what's going on now. We need to be aware of all this. This is inflation. So we're looking at commodity prices, and commodity prices go across the board. They're also agricultural prices. So corn, soybeans, wheat, rice, all the basic foodstuffs are all increasing at a startling rates. Now, in the CRB commodity index, the commodities, which also include agricultural, and of course, it includes the basic building. So we're talking about copper, aluminum, lumber, oil, concrete, cement. These commodity prices are up 73%. Now, that's no longer benign inflation. That means when you have inflation coming in at 73%, we're not going to be in benign of 1.5 or 2%. And in 20 years, you lost half your purchasing power. Now, if you think back 20 years ago, you could go to Costco and buy loaves of bread for $2. Now they're $5. Now you get 2 loaves, but you used to be able to get them for half of that. And gasoline is up. It's over $3. You know, we were looking at 4. Gasoline drops. So what if gasoline goes up to $70, $80, $90 again a barrel? And I'm sure if you look and think back in 20 years ago, your electric bill was a lot less money. Your taxes were certainly less. Your insurance was certainly less. going to the dentist and going to the doctor, all these things were less money. And that's inflation, because in the last 20 years, things have gotten more expensive. Let me go back to my screen again. And let's go to the next slide. So this CPI year over year is spiking. Now, the problem with inflation is that once it gets ignited and gets going, it gets to be a pretty pervasive event. And it takes a long time to stop it. Typically, the only thing that really stops an inflationary period is a recession. And the higher the inflation goes, the worse recession that you're going to get. Neither one of these are good. So we need to start looking at the fact of what's going to happen. Now, in the short term, we've got inflation that's running 3 or 4 or 5%. But as the last slide just showed, we're looking at a commodity increase of 73%. Now, that's not into the pipeline yet. It's coming. So you can pretty much expect that prices are going to go up pretty substantially. So what are you going to do with it? Now, if you're retiring, you need income. And of course, we need income that's going to pay all our bills. And you can say, well, my house is paid for. You know, the cars are paid for. But, you know, we as baby boomers, when we retire, the house may be paid for. So there's no mortgage payment, but we certainly have to pay for the HOA. You know, the homeowner associations have all doubled in the last 5, 6, 7 years. You have to pay electricity and water bills. Those are all up. Your taxes are certainly higher than they were, and including income tax. Income tax is going up, so you're going to have to be paying that as well. Do you want to go on a cruise? You know that you're paying more for these things. So your fixed income is going to be under pressure. So let's just take a look at what that's done. So we have an historic money supply. Now, this is the government's response to when you have a terrible recession. They want to flood the market with money. They think that money is going to change all the evils of the world. And look at this. I've talked about this before. We have got a historic increase in money supply, both here nationally and internationally, trillions and trillions and trillions of dollars. Now, you know, in March of 2020, President Trump put out $6.3 trillion between the Federal Reserve and the Treasury. All this money is going to find a home. It's going to raise prices. It's going to fuel things. And we've got a historic amount of money. And it's globally. You know, the prices are going to go up like crazy. Now, if you're a bond investor, let's just talk about being a bond investor. Let's talk about that. If you're a bond investor, it's been wonderful. Bonds send you a very predictable income stream. It comes each and every month. It's very, very easy for you to do. We can get this each and every month. Sometimes it comes in semi-annually, sometimes it's annually, but you know it's very predictable. Now, I'm not going to talk about the risks that are inherent in some of the junk bonds, because we've got a lot of bonds that are triple B that are one notch above junk. But I just want to talk about the general nature of the bond market itself. Now, I'm not an expert in bonds, so you want to talk to your financial advisor, but this is kind of, you know, I'm getting to be your age. You know, we haven't been around all this long time without learning something as we go along. So here's what happens with bonds. So let's go back to my screen. We're talking about bond investors, and it's been wonderful. It's been a great, great run. So as bond prices come down, interest rates come down, bond prices go up. We've been on this enormous ride. If you've been following my work, you know, I've been talking to Charles Nenner. You know, bonds are on about a 78-year cycle. That means it's 39 years one way and 39 years the next. And we have been enjoying this downcrease. So you remember, if you're my age, Paul Volcker raised interest rates in 81 to enormous heights. So like, interest rates were over 20% on the short term, and they've come down over all this time, but then they've bottomed. So now as interest rates have come down, the price of bonds have gone up. So if you've been a bond investor, this has been wonderful. You've earned income and the value of your bonds have gone up. But now let's look at the next slide. The bonds have gotten down to the ludicrous. We're down here where they're less than 1% for the 30-year treasury. Now you have to have millions and millions and millions of dollars of bonds at 1% to be able to survive, because the yield has dropped to next to nothing. It's really not a survivable rate. So this is probably the 30-year treasury, probably one of the most risk-free investments in the world. So you've taken no risk, but you're not getting any yield. So a lot of people have gone into much more riskier bonds. And as I mentioned before, there's an awful lot of companies that have corporate bonds that are really rated BBB. They're really one notch above junk. Any kind of hiccup in the economy, and they're going to default, which puts pressure on, of course, on your investments. But now look what's happening here. We've come down, but interest rates have come back up. So we're here at 1%, and that's the end of the treasury, of the interest rate cycle from the treasury bills. The yields have come down and they've bottomed. If you follow my work, we talked to Charles Denner, you look at a lot of the analysts, and a lot of people are in agreement that interest rates are probably heading higher. Now that's really good in the fact that, we can get a more livable rate. The rate actually has doubled. So it went from 1 to over 2.3%. That's great, because now you're getting double the amount of yield. However, if you've been holding your bonds, your value of those bonds has gone down. Now, a U.S. Treasury note is going to pay off. So if you bought this a 30-year, here's what happened. If you bought a Treasury note in the latter part of 2019 and you paid $10,000 and you got a 1% note, well, interest rates are now 2.3%. But because you bought a fixed rate Treasury note, you're only yielding 1%. That's all you're going to get because it's fixed. That's when you bought it. Now rates have gone up to 2.3. They've actually doubled. So that makes your Treasury bond nowhere near as valuable as the ones that you can get double the interest rate. So your value of that bond has gone down, but you're still getting the same amount of interest. Now, if you're a bond fund, your bond fund would have moved up to 2.3%, but again, the value of your holdings would have dropped. So you'd be still getting the same amount of money. It's just that it's being expressed at 2.3%, but you're going to be looking at less and less value of your holdings. Now, if it's a U.S. Treasury, you're eventually going to get your money back. If you're holding in a fund, there's no maturity in funds. Your fund is just going to reflect the fact that you've lost value, and the holdings of your portfolio is going to lose value. You're going to lose money. So if you had $10,000 at 1%, earning you $100, now you're going to have $10,000. You're going to have probably $7,500 at 2%, still giving you $100. So I'll have to work that math out exactly, but that's what happens. There's a duration risk that you're running. You need to talk to your financial advisor on that, but you're going to get the same yield, even though the interest rates have come up because you purchase it, it's fixed income, and the value of your holdings drops and your income monthly remains unchanged. This is not good for us as baby boomers. Now, whereas baby boomers, we need income. And we also want to protect our holdings because somewhere along the line, we might get sick. And here's what I see when I consult with my clients. They forget that we want to change our furniture. We want to buy new cars. We want to buy something for our kids. Maybe we have a favorite grandchild that really needs a little bit of help, and we want to cash in some of our holdings to pay for their college, pay for that special school. Maybe they need something, maybe help them with their first house. And we want to protect our capital gains. We want to protect that nest egg. So if you're my age, if you have a nest egg and you need income, either you're selling your nest egg or the value of your income has dropped. So if you have fixed income, you don't have a growth in your portfolio. And even though you may get fluctuations in the value of your bonds, probably heading down, your income remains the same. However, again, as we just talked about, you have inflation. So prices keep going up and you have price pressure. It's not a good thing for us as baby boomers to do that. Let me go to the next screen here and we'll talk about that. So we talked about the fact that interest rates are probably bottom and heading back up. But if you've been holding for all this time, it's a problem for us. So let's contrast that to rental homes and see if this might not be a place for you to put a portion of your money. Again, I'd like you to talk to your financial advisor, discuss this with your spouse, discuss this with your family, discuss this with your CPA. But let's just explain the difference as to how this is going to impact you and when you're retiring, how this is going to change your retirement landscape. Now, a rental home, now, this is part of our portfolio. These are just standard homes. This is part of our rental portfolio. We look at these homes for anywhere from like 1,100 square feet to 1,900 square feet. These are portfolio homes. They rent all the time. Yeah, everybody can afford them. They're easy to lease. If we want to sell them and trade them, we certainly can do that. These are very, very affordable properties. Lots of markets across the country just have tons of them. You know, a lot of small villages and towns and small cities across the country have these. But you know, in the great markets like Florida, Texas, and Arizona, they're doing exceptionally well. And here in my market, I'm in Maricopa County, we are getting almost 300 people a day. We just got these statistics. 300 people every single day moving here to Phoenix, Arizona. We just can't keep up with the amount of people that are coming here. So our rents have been going up. And this is something that changes. It's a variable income for you. Now, we haven't seen rents go down too much. We've basically seen them go up for 40 years. So let's just talk about that. So here's what we're seeing now nationally. So we're seeing the prices. This blue line is the rental increases on a percentage basis going up. Nationally, we've seen rental increases of 8.5%. Now that's taking all the places that aren't doing well. You know, we've had New York City where people are leaving in droves. We've seen people in Chicago leaving in droves. This puts downward pressure on rentals. So if you're in downtown Chicago or in Manhattan, people are leaving. They've got problems. Same with Seattle. These people are leaving in Los Angeles. These are markets where people are leaving. And of course, that puts pressure on national rates. Even so, nationally, with all of these markets that are having problems, rents have gone up 8.5%. So think if you have $100,000 last year in income coming in, and you just got an 8.5% increase. So no longer are you getting $100,000, you're getting $108,500 increase. Your rental portfolio just went up 8.5%. Now that's nationally. Here in my markets, and this is not contained to just my market, you're seeing this in Florida, Texas, Arizona, some of the big markets across the country. We had a 19% increase in our rents last year. 19%. So if you were getting $100,000 last year, this year you're getting almost $120,000 rental increase. And look at this. This is average weeks on the market. We're down to 0. We're here. This is a national figure, by the way. So even in those bad markets like New York and Chicago and Seattle, where people are leaving, they're getting down to where there's so much rental pressure, there's virtually no vacancy factor at all. So this is a national figure. Here in Arizona, we put a sign in the front yard and we're getting 2, 3, 4 people in the first hour. We're going to get 10, 20 people in the first week wanting to rent a property. The problem is choosing one of these and not hurting people's feelings, because we're trying to pick the best renter we can, and tenants aren't moving. So our tenants have become very, very long-term. Typically, they're running 3 to 5 years anyway. They're not leaving because they're having trouble finding other places to go. So this goes right into our real estate cycle that we've been talking about for a long, long time. This is the accumulation phase. I see this happening for the next couple of years. We're going to see rising home prices. And as a baby boomer, let me just go through this. As a baby boomer, we're maintaining our capital base. Even if you put a little mortgage on a property, would not be that bad in an inflationary environment. We're going to pay that off in much cheaper dollars. So we have many, many strategies for you, and we'd love to talk to you and your financial advisor and see how this is going to work for you. But your capital base, so if you have a $2 million, you're not spending it. That $2 million, again, last year in Phoenix, now our wheelhouse and where we play is in the entry levels. Those were up over 20%. So if you had $2 million with us, with a 20% increase, you now have $2,400,000 in 1 year. Plus you'd had almost a 20% increase in rent. So it was a pretty good year. That's what happens when you're in the accumulation phase, which is what we're in right now. You see a lot of that, and then we go into the explosive phase. So we've got 3 or 4 years where we can really boost your portfolio, really help out your retirement, really solidify where you're at. You know, again, if you read my books, I highly recommend that you buy properties, and it's kind of a lifetime type of thing. But if you had 10 free and clear properties that you've accumulated, and they're free and clear here in Maricopa County, after everyone gets paid, you know, hiring a professional manager for yourself, paying all the costs of sales, paying all the things that could possibly break, because we do a repair escrow. We take, in fact, the vacancy factor. You know, you got taxes, insurance, homeowners fees on these properties. After all of those are paid, you're still going to get about $1,200 to $1,500 a month on every property that you own. So if you had 10 of these, you're going to be getting $12,000 to $15,000 every month for the rest of your life. Every month for the rest of your life. This is a good thing. We'd like you to continue. So now I put this slide in for you to remind you that I am marketing. I'm trying to bring this message to everyone. This is something that everyone needs. So if you like it, give me a thumbs up. And if you like my message, subscribe to my channel. Well, this is a message for you. You're welcome to reach me. We'll talk to you and your spouse. Talk to your financial advisor, your estate planner. There's lots and lots of good things. I'm here in Maricopa County, Phoenix, Scottsdale, Peoria, 5 hours east of Los Angeles. We're getting 300 new residents every single day coming here to Arizona. I'm also an author. I'm going to tell you this. You're welcome to reach me at michael@michaeldeville.com. You can go to Amazon or Barnes and Noble. You can go to Apple and buy my books. They're all over the world. So I would appreciate any business you send our way. My very, very best to you. If I can help in any way, we're here in Phoenix. My group is very, very, very good at what we do. You're welcome to reach me at michael@michaeldeville.com. In the meantime, my very best to you. Bye-bye.